you think about all these rising warnings among regulators, and part of this is because they don't really have oversight over the system. So when you think about what's being done outside of the regulatory purview, what is working and what is of concern?
Yeah, absolutely. I think the most concerning area, Sonali, is just the emergence of new asset types as it pertains to collateral. And when you say asset-backed finance, it means a lot of things to different people. Historically, it has been a very plain vanilla market, dominated primarily by credit like auto loans and credit card receivables. But over the last decade, it has definitely evolved to more esoteric types of lending. And now it includes things like solar, franchise receivable, data center, music royalties, aviation leasing, and more asset classes sort of that emerged over the last year. And I think there is some opaqueness pertaining to the valuation of some of those more esoteric assets, which is where credit investors need to really be diligent in understanding what they're lending against and how much volatility there can be in some of those new and evolving asset types that have not been tested through a market cycle, that have not been through an environment of ups and downs.
I think this kind of recalibration on what is risky and what is safe is a very important conversation. You think about auto loans. In the public markets, you have a lot of people concerned about that sector, yet it has traditionally been perceived as safe. When you think about both public and private right now, what are the riskier areas when you think about collateral?
Well, I think it's not so much about the collateral as it is about the convergence of public and private that are coming together. And so we are seeing those blurring lines. We are seeing the delineation between public and private becoming a little bit more blurry. And similarly, the delineation between fixed income and alternatives is also becoming a little bit more blurry. And really the biggest tailwind that's causing some of this evolution in the system, if you will, is the bank disintermediation that is caused by regulation. And what that means is you have this generational transfer of assets from bank balance sheet into non-bank entity balance sheets. And as a result of that, we have this new ecosystem with three types of key players emerging. One is banks. The second one is asset managers, and the third one is insurance capital, which is becoming an extremely important part of the puzzle.
You know, I had a conversation just a couple of weeks ago with Apollo's CEO, Mark Rowan. He's been a big advocate of this public and private market convergence, even trying to make an ETF tied to private credit. But if you think about all the different ways you're seeing the blurry lines show up, what's an example of that? What does that look like in your world?
Yeah, absolutely. And I think the way to think about it is the underlying collateral. And that is largely the same, whether you play in public markets or private markets, whether it's liquid or illiquid. Obviously, the format needs to be tailored to investor needs. And so we are yet to see this idea of a liquid ETF that's supported by liquid assets that I think is something that we need to watch out for. But as it pertains to asset-based finance, it's probably the fastest growing frontier within private credit that has been so far dominated primarily by direct lending. And as a result of the recent changes, I think everybody is looking to asset-based finance to really harness this growth opportunity. We at Barings feel very excited about it because we have the breadth and depth of capital and capabilities to really jump at it and capitalize on it. And it's really supported by three things. One, we have long history in credit. We have $430 billion in AUM. We have been playing in public and private credit for multiple decades. So really credit is the core of our DNA. And secondly, back to the insurance point that I made, we're owned by MassMutual Insurance. It's one of the largest and highest rated insurance capital companies in the world. And it is a mutual company, which I think is a very important aspect to make because it's not driven by short-termism.